Hello, my YouTube friends, and good morning. I hope you're all doing well. What an exciting week. Actually, pretty crazy. I assume you were all watching. I'm kind of enjoying this once a week thing because it gives me a lot to talk about. In today's video, I want to talk about what the Fed did, the jobs report on Friday, the yen carry trade, as well as what the markets did, and if there's opportunity or if this is the beginning of a down move. So stick around. Hopefully, it's a great video. So, despite me being a rational investor, I too get a little bit emotional and worry about these big down moves. The reality is, I'm actually buying into it, even though it concerns me. But to be fair to the gloom and doomers out there, there are real concerns, and the jobs report is one of the major factors. The question is it getting ahead of the Fed, or is the Fed going to be able to stay ahead of it? My concern is that the Fed has proven already on the one direction that they tend to be late to the party. And I think that's going to be the same going back the other way. The markets have predicted a 50 basis point cut coming in September and feel like they probably should have cut this week. Maybe that's true, but maybe they don't really have control of things the way that they hope. And like going the other direction, there's going to be a lag in things. Where I think the markets are wrong is I don't think Powell's going to want to do 50 basis points, even if he thinks he should. And my guess is he'll be slow and low and behind the economy slowdown. With the jobs report coming in, however you want to look at it, whether it's hot or, too high or too many unemployed and everything else, the question is, does that get out of hand or does it just slowly stay around where it is, allowing the economy to slow down the way the Fed was hoping? I don't know the answer to that. And I think when you see the stock market pullback that we had, what's good about it is seeing the VIX go up to, 28 or wherever it got shows that there's a good amount of panic in the economy or in the markets. But I think why you're seeing the pullback is if the economy's slowing, that the estimates for the future earnings are probably overinflated, even though the companies have already brought them in line. To help you understand, that means if there's less money flowing from consumers to things, there's going to be less money to spend, even when it comes down to buying these chips with NVIDIA. And I think you're going to see a great report this quarter. And I think you're likely to see next quarter be really good. But if the economy really continues to slow down, eventually other companies are going to have to slow down their spending, which is going to impact even the Nvidias of the world. The place where I still love is Meta crushed earnings again. Their ability to grow earnings in the advertising space and how they're using AI to do it and everything else that they were talking about. I see them as a bit of a moat that I think is going to be hard to slow down. Maybe I'm wrong, and maybe like everything, there'll just be an overall slowdown. And maybe there really won't be, and this is just a great buying opportunity. Now, keep in mind, if the market really does correct, as long as whomever is watching and my friends out there or whatever is able to keep their jobs and continue paying their bills and continue to save, in the long run, it'll work out great. I think what's really tough about this economy is those that are on the lower end are really struggling, which is going to be part of the slowdown. They're not able to do much out of pay their rent and buy their groceries and simply survive. I also feel like even if the Fed cut at this meeting and the jobs report came out the day after on Friday, that we probably would have had the same type of move that we had either way. I think the concern is the economy ahead of the Fed? Are we going to have much larger unemployment? Are we going to see everything erupt like we did in 2008? And while things are always the same, they're also always different. I don't see a big collapse like 2008 because I don't think we're quite leveraged the same way. What I do worry about is when I look at the housing market, to be fair to the people who talk about this big gloom and doom collapse that's coming, prices are high and rates are, or at least were high. They're already coming down, but I don't know that we'll get them to come down back to where people want them. And it really is an inventory issue, at least here in Las Vegas. Now, I've seen other places, and I talked about it in last week's video, like Florida has had a big increase of inventory, and so has Texas and some other areas. But when you get here in Las Vegas, we just don't have the inventory increase that other places have. And if rates go down, do prices then go up? I actually don't see a huge influx of demand coming in, even with the rates correcting a good bit. I'm not sure if that'll continue all the way down. And what that's concerning about that is that maybe there is a real economy slowdown coming. And this is where being diversified and having those companies that were out of favor come into value so much. I mean, look at what Bristol Myers and Pfizer and the ones that nobody has liked did this week, while your Amazons and Googles. And look, don't get me wrong, these are companies I love and they're the largest in my portfolio as well. And I also think that in 5 or 10 years, Amazon is a bigger company than it is today. So it doesn't really waver what I do in my investments. But I'm also really glad that I picked up some of the Bristol Myers and the Pfizers of the world and the things that were so out of favor that they just seemed cheap. And as rates come down, a company like Pfizer or Bristol Myers that I'm using in these examples that are paying a 5% dividend. And I don't really see that in jeopardy because they're not using a ton of their cash to be able to make that dividend. And I also don't see, even if there's a slowdown, that they're not going to be able to still sell medicine and generate revenue and continue to grow earnings. Well, at 5% dividend becomes so much more valuable if the rates come down, and you can't get that any longer in a high yielding money market or in a CD or even a 2 year treasury. If those start to fall, maybe some of that money pushes into companies that are paying a 5% yield that people see as a safe return or a safe dividend that they don't really see getting cut anytime soon. Now, keep in mind, it can get cut at any time. Companies can get rid of them. I mean, look at what happened with Intel. They got rid of it completely. They had a terrible day on Friday. Also, as always, for disclaimer, this is not financial advice. Please don't use any of the information that I share to make decisions with your portfolio. Reach out to your financial advisor or do your own research, however you do things. I'm just sharing my information for entertainment purposes, and I hope you guys enjoy it. Now, I still think that means that those safe yielding dividend stocks become a really good value. But that's sort of some of the rotation you've been seeing in the market. Now you saw the wind come out of the sails on a lot of it on Friday, but I think that's because if there's a slowdown, that doesn't necessarily mean that the small caps in the Russell 2000s just do great because interest rates come down. I am thrown off about some things like Nextera Energy Partners. They should be super sensitive to the interest rates because the dividend is so strong, and the concern of how they're going to refinance their debt in a couple of years when it has to be refinanced. If rates are coming down, it should put them in a better position to be able to redo all that stuff and not have big problems down the road. So it was really interesting to see how their stock bounced around and actually didn't do as well as I thought it would. Same with another one that threw me off that I haven't talked about much is Starwood Properties. Now, I do think a slowdown could impact how many people are going to use hotel chains and travel and things of that nature. But when I think of Starwood, I think of them in a space that's pretty affordable. So even if there's a slowdown, maybe people who are spending more on more expensive hotels take a step down to some of the Starwood properties. And they're a REIT that pays a high dividend, so I thought maybe that it would hold up better than it did, but it got beat up pretty good as well. And then the Amazons and the Googles who actually beat earnings expectations. And then the markets picked on specific things that they were unhappy with, and maybe they were just over optimistic about what they expected. And then Amazon in particular, but Google as well, really got punished. And I think that's because if there's an actual slowdown, the retail's going to hurt and it's really going to impact their earnings over time, and people are overestimating the future earnings because if things slow, those future earnings aren't going to be accurate. And then what's going on with the yen? Why is everybody talking about it and how is that impacting the markets? Well, to be fair, I actually bought yen currency 2 years ago. I've been 2 years early. My wife's made fun of me a bunch of times because I've kind of said, it's just too cheap. I don't see it staying that way. Now, I did it in a way that it's not hard to hold the position. For those of you who've been watching for a while, I think you're aware I used to be a commodities trader, and the yen is what I specialized in. I traded yen futures at the Chicago Mercantile Exchange. Well, I've seen it in a pretty big range, but it tends to move for 10 or 15 years very slowly. I was trading the currency future, and the ups and downs were too volatile. So essentially, I took delivery on a certain amount of a future and just put that in an account and left it. Now, the past 2 years, like I said, it's slowly been going against me, and it just kind of threw me off. I did have one friend go to Japan this summer, and he started talking about how cheap things were in Tokyo. And I thought, boy, we've got to be pretty much near the end because Tokyo is not going to be an inexpensive city. It is somewhere that people love to go. I was fortunate enough to get to go there last year, and it's incredible. I just don't see how it's possible that that'll be something that's inexpensive for people to go to, and even the news was talking about how it's becoming a shopping haven because it's gotten such to be such a good value. Well, sure enough, in a very short amount of time, it started to reverse. They're raising their interest rates. And why does this all matter? Well, if you are a big, and I mean really big, not big like friends who are real wealthy or whatever else, but conglomerates that put money together and corporations and things of that nature, and you have an interest rate that's zero or negative, odds are you're probably going to leverage whatever you can because it's so cheap to borrow and buy all sorts of assets. Hopefully that all makes sense so far. What's going on though is as that reverses, and the yen starts getting stronger and the dollar starts getting weaker, and they start raising the interest rates even a little bit, if you've bought all those assets, you might be rushing to start sell all those assets to start getting the yen back to be able to repay all the debts that you've taken on before they start getting to be too expensive. Does that all make sense? I hope so, so far. So if you've bought, whether it's American equities, or I'm guessing, I didn't even look at it, but I bet I would guess that the Nikkei is down, and anything else that are assets that people might have bought with money they borrowed off of Japanese yen. As that continues, it'll continue. The thing is, the rush will be early on in the beginning as the investors see it coming before they end up in a position where it becomes too expensive to get out of those things, meaning the assets have gone down too much and you need to raise too much yen to be able to pay it back. But at least in the beginning, they'll rush as quickly as they can, which is part of why you see how quickly the markets move, because the government's been really clear that they're going to continue to raise interest rates. Now, I really think this is a long term trend, not necessarily the pushing the equities down a whole ton and the assets and everything else. But the currency move, I do think we got to the end of one move in one direction, and you're now seeing the bottom play out, or the top, depending on if you're looking at the dollar or if you're looking at the yen, and that you're going to see it reverse, and it'll have ups and downs all along the way. But I would expect it to start reversing and continue for the next 10 to 15 years, if not longer. I was saying to a friend of mine, when I started at the exchange, I remember that the dollar was really weak, and we had lots of Europeans coming to visit the US because it was so cheap for them to visit here. It then reversed. Americans started going to Europe and other places because our currency got too strong. Then it reversed again, and now it's going back the other way. Like, we finally got to where it was inexpensive for Americans to travel abroad. We had a huge amount of people this summer travel to Europe, which including me, Asia, and all sorts of places because the dollar is so strong. We've gone too far, in my opinion. Well, give it time. It'll reverse the other way, and you'll see all sorts of, whether it's Chinese or Japanese or Europeans or whomever, coming over to visit the US because my guess is in 10 or 15 years, our currency will have gotten too weak and theirs will have gotten too strong, and it'll become really affordable for them to travel here. I think this is the beginning of that turn in the cycle. May not be a great trade. I don't know that there's huge money unless you over leverage in currencies. Even when I look at the position I put on, it's kind of silly. Outside of when we went to Japan, my son loved it so much. He talked about maybe going there when he went to college. And my thought was, geez, the currency's cheap enough if he really does in 5 or 6 years, no matter which way the currency goes. I'm content buying it now and just making that investment for that future. And if it reverses, I'll be in a great position where I won't feel the pain of that the dollar's weaker and that currency change and everything else. You know, now being a trader, I'll vent a little bit. What drives me nuts is that spread that the banks take. Part of why I did that is when we went there, when the currency moves at the exchange, that is 1/100th of a penny. So when I go up to those currency exchange booths, I don't care if they say commission, no commission, whatever. That's like pennies. But when they tell you that, and I'm going to make up numbers, but the euro spread, you can sell it at 103 and we'll buy it at 110. My God, that is 700 points at the exchange, and the bid and ask is usually one half of a point. So when I see it 700 points wide, that's just crazy to me how much they're taking out of it. So I figured if I bought it at the exchange, it's only one half of a point. Now, the company that I use said they charge $250 to be able to send me like that to a bank. Then I ran into the issue of what bank can I actually send Japanese yen to? So I've left it at my old trading firm. It's sitting in yen, but it's really hard to convert it because what I was really hoping was to get the actual yen, to get the cash and just throw it in a safe deposit box or something and be able to use it when I travel. But it's a lot harder than I thought it would be. And I'm sure not going to the bank and using their exchange rates to do that stuff. At some point, I'll figure it out. If he actually goes there when he goes to college, maybe there's a way he just has to open an account in Japan and I get it sent there and not get ripped off on all the fees. Anyway, that's what's going on with the yen and why you see the stock market affected by it and why people are talking about it. I don't think the Japanese own a whole ton of property here. Maybe they do in commercial space or something else, but I don't see the residential having some big turn because the Japanese need to raise, yen and get out of assets. If it was actually what was going on in China, I'd be a lot more concerned. I do think we had, or Russia as well. I do think we have a lot of Russian and Chinese investors who own homes that probably don't even live in those properties. And you could see those properties come to market if they really needed to build up some of their currency to pay down debts they've taken on. That's why people are talking about it. That's why they equate it to the stock market. I don't know if that's the actual reason the markets are correcting. I really think they're correcting because if there's a slowdown, that you're just going to see the earnings not be as good as they've been predicted. Do I think it's an overreaction? Probably. I would still be cautious because there could be legitimate follow through. We could go through a really bad recessionary time. I don't really think that's coming, and I'm not making any moves to prepare for some gloom and doom scenario. At the same time, I do prepare for it in the sense that mentally, if it does come, I'm waiting to be able to pick up things relatively inexpensive, and I hope you guys do the same thing. If the market really does crash and you don't lose your job, it's an opportunity to buy up equities for less money. And as somebody who does mortgages, I talk about what I think in the real estate and I don't really see prices going down. I don't want people confused because when I watch the gloom and doomers, they keep making comments like, oh, of course, these real estate professionals, they want the market to be higher and they're going to lie to you. Are you kidding me? Do you know how good it would be for my business if the market collapsed and the Fed cut interest rates? There are still people working, and a lot of people have left my industry. If the prices of the homes drop dramatically and the Fed rushed to cut interest rates to try to quote unquote save that economy, I'd be really busy at work. So there's nothing I would want more than that. It is not my want that I share, it is my opinion that I share. And there's not a lot of inventory here in Vegas, and there still is demand. It has waned, but as rates come down, if we don't get more inventory, it's really natural that that would just push the prices even higher. I don't know that that's what's going to happen, but that is what I envision. And it's kind of where I think we're headed because I do see properties coming to other places. I think the reason we're becoming a bit of a moat is, man, even when I traveled around the world, if I said I lived in Vegas, people are like, oh, Vegas. And it's a little why I moved here. When I thought of that wow factor and places that people have heard of and where they want to go visit, New York, California, Hawaii, Vegas. I don't think anything else in the US fits that list as high as those things. And while there are other cities that are great that might be bigger or have more people that live there, as a tourist destination, a place that people want to see and visit, Vegas is pretty high up on that list. Well, once people visit, maybe they want to own a property there and it pushes prices higher than they should be. I don't think that ever changes, kind of like Hawaii. If people want a property there, you're going to have outsiders pushing the prices up. And then you're going to have more people moving there, which is what we've had. We've had a huge influx. And then you add to it that we've added sports teams. We already have two. We have the Golden Knights and we have the Raiders. Now we have F1 racing coming. This, well, already came, but here. You have the Sphere. They're talking about the potential of the A's coming and some other things. And we also have Hollywood studios coming. I think all of these things keep driving more and more people into our community. And with not a lot of inventory, it's natural, what's the basics of economics, which is supply and demand. It's not really interest rates when they talk about it. Now, interest rates will affect that because people figure out what they can afford based on their monthly payment. But unless we have more inventory come to the market, which maybe we do, I just don't see where at this point, that I don't see prices coming down. I do see opportunity for better prices in other parts of the country. And again, I see that as opportunity. So where does that leave us and what are the things I'm looking for? I'm looking for stability right now. I'm comfortable being in companies like McDonald's and, as I mentioned, Bristol Myers and those. I think they'll go down if the economy goes down as well, but at a much slower pace than the ones that have been high flyers. I don't think their price to earnings need to come in quite the same. They've been through these cycles many times. And look, McDonald's has already gotten ahead of it with their $5 value meals. I know people on YouTube are making fun of that stuff, but quite honestly, my guess is they're having good response to it and it's driving customers back into their business. I kind of wish Starbucks would think of something on the same lines to compete in that area because I do think inflation has been tough on people. And during those times, it's really good to have options if you're in the food industry of things that are inexpensive because that drives people in and it actually puts competition out who doesn't beat you to it and who doesn't come up with it. To be honest, I made an unbelievable burger the other day. It had my head going and spinning about doing a burger restaurant again. I hated the restaurant business. I don't know why. I can't help it, but I can't help it. And then like I said with Pfizer and Bristol Myers and things in the healthcare space, I don't really see their sales hurting. People need those things no matter what the economy is doing, which makes it a little bit of a safe haven. I also still want to own the things like Google and Amazon and Meta. Um, they're great companies that I think over the long run are going to continue to perform and have a good product. The one I struggle with right now the most is Costco because I love Costco. And no matter whether the economy does well or does poorly, there's reason that it continues to grow. My only concern is that it's got such a high valuation, even if it grows, it has to make more sense for the value of the company. I don't know. It's still a company I want to own. I think they're the best of the best. During slowdown times, people tend to flock towards it because they have good prices. Um, and during good times, people tend to flock to it because it's a good company. And once they find it, they shop there and spend. So you guys have to make your decisions, like I've said. I hope you had a good week. I hope you're having a good weekend. Do me a favor if you haven't already, hit that subscribe button, smash the like button. Tell me what you think about the economy. Do you think that we have a huge collapse coming? Or do you think that this is just another part of the cycle where it gives a bit of a scare and catches itself and just keeps drifting higher to make new highs? I think I'm still in the camp of we'll probably make new highs. I think once the election ends or once we get close to it, you'll see it catch itself. But I guess we'll see. Anyway, again, thumbs up, like, subscribe, say hello, tell me how you guys are doing. Bye bye.